afternoon and welcome. Thank you all for joining us today for the fifth segment in our series of The Devils in the Divorce Details, where we'll be wrapping up our segment on attaining financial independence. Over the course of this series, our goal was to create a roadmap of learning by really discussing topics that we felt were relevant to clients that were contemplating or actually in the throes of divorce, including financial issues, including emotional issues. And, you know, with the first couple of weeks, we've talked about some of the emotional issues around is getting divorced during a pandemic a smart thing to do? Another thing we talked about on the emotional side was, should I stay or should I go? A very gut-wrenching decision. And then we shared with you the 4 ways to get divorced in Colorado. And last week we covered spending plans and banking. So today we'll be discussing all things credit. And we'll be including the importance of first building and then maintaining good credit, because you'll use credit throughout your lifetime. And then also we want to talk a little bit about the inner workings of a credit report and your FICO score. And then a big issue is securing a mortgage, or where are the parties going to live post-divorce and can they afford to live there? And then finally, I wanted to cover a little bit about the nuances of credit and debit cards today.
Mm-hmm. And the reason we're discussing credit today is because one of the most crucial and often complex tasks in the divorce process is resolving the issue of post-divorce living arrangements. It's really important to address this issue early in the divorce process. One of the components which makes this issue complex is mortgages. And there's a few crucial questions regarding this issue. Can the parties qualify to refinance or purchase a new residence? And can they afford to make the payments after the divorce is final and the dust is settled? Or can't one of the parties just assume the mortgage of the marital home? These are really important questions that knowledgeable professionals help answer. And I'm really happy to have our special guest here today, who has over 25 years experience and is talking to us today about mortgages and credit.
Yes, today we're excited to have as our guest Michelle Otto of Leader One Financial. And Michelle specializes in all things mortgages. Not only is Michelle a very knowledgeable and experienced mortgage professional, but she also earned the designation of Certified Divorce Lending Professional. That's a CDLP. And that truly sets her apart in the mortgage industry when working with clients going through the difficult life transition of divorce. Michelle, thank you so much for sharing your time and all of your expertise with us today on this critical subject. And I think let's just jump right in. Michelle, one of the things that we run into quite often is the difficult situation where one spouse is the primary breadwinner, and then upon divorce, the other spouse, for whatever reason, feels that they need to retain the family residence. So if the spouse wanted to stay in the family residence post-divorce, what would they need to do?
Well, first of all, thank you for having me, and I'm very passionate about this subject. So love these questions, and hopefully we'll be able to answer. And anything somebody has a question on later, you know, feel free to reach out. But in terms of primary breadwinner, there's 2 different situations. There might be one where maybe one spouse was the primary breadwinner and the other spouse wants to stay in the home. So the question is, did that person also have some income or did they have no income? So that's the first thing we look at. We would need to determine, you know, we'd like to get involved early in the process. And that's something you guys are really good about, is bringing the lending professional in. So that we're not trying to, at the end of the, you know, the process, go back and figure out what we could have done better. In terms of the primary breadwinner versus the person staying in the home, you know, we'll just use an example. Let's just say the wife was not the primary breadwinner and she's going to stay in the home. The first thing we would do is we'd want to pull credit so we could see what debts there are versus the income situation. And then, does she have some income? Will she have a job, or does she have no income and she'll be solely relying on support? And if that's the case, then we have to determine So for a conventional loan, she would need to receive 6 months worth of support prior to closing on our loan to use that income to qualify. So really it's just, we have to look at the whole picture and determine how much would the new mortgage payment be, depending on what we're doing. Is there other debts that need to be included in that debt ratio? And then how much income will we have to qualify, and how much income do we need to make this work? Whether it's a support or income or a combination of both. You know, a job and support. An FHA loan, we need 3 months worth of support. And temporary support can count toward those months. So in the workings of the, you know, working through the situation with you or whoever they're working with, that, you know, we can use those temporary support payments as long as there are separate accounts set up for each respective, you know, person.
That's great to hear. So then someone that will be reliant solely on child and spousal support because they didn't have a career, then they could qualify for a mortgage provided they met the debt to income ratio and some of the others. Is that correct? Yes,
that is correct. And so again, that's why it's great when we get involved early in the process, is we would pull credit, we would look at what debts are there. We would be communicating with you in terms of, or with the, you know, that particular person, in terms of what debts will remain versus what might get paid off either through this loan that we're doing or through the ex-spouse. Maybe that person will be paying the debts off. But the question being, what debts will be left at the end of the day when we close on our loan, and how much income do we need through the spousal support or child support, and that we've already achieved the 3 months if we're doing an FHA loan, or 6 months if it's conventional, and it must continue for 3 years after closing on our loan. So if we're doing a combination of spousal support and child support, sometimes one lasts longer than the other. We just need to make sure if we need all of that income, that both of those incomes would last at least 3 years after from the time of our loan closing. And they can receive that 6th month of support or 3rd month, depending on which loan we're doing, in the month we're closing. So for instance, I have a loan closing this month in June, and she will get her 6th month, you know, probably next week, and then we'll close on the loan.
Great. And so you mentioned in there credit. How, in someone in that situation, how, if their credit isn't where it should be, how do they build credit in that situation?
So depending on if there are credit blemishes that we need to let season, or, you know, get their credit score up just because there are derogatory credit items. But it sounds like you're asking specifically, like they just don't have much credit or much of their own. So in either one of those situations, you know, obviously we would look at where the credit is today and then figure out where we need to be and put together a plan to get there. And that's something that we specialize in, you know, on my team. That's something I really pride myself in, is really understanding the credit. And so if we just need to build some credit, like let's just say that the husband or wife, whoever I'm doing the loan with, doesn't have much of their own credit, then we would help them build credit. And that could be done through a few different ways. Specifically, what we typically recommend is a secured credit card. And so several of the banks will offer that, and we can make recommendations as well. And really anybody can get a credit card with a secured account. And what it would look like is, let's just say they put $300 into a savings account with that bank. The bank would give a credit card against that collateral of that $300. They can't touch the money. It just sits there almost like, you know, in a savings that is the collateral for the credit card. It doesn't need to be a big limit. $300 is enough to build credit. It's more about the percentage of the balance used versus the limit. So if they had a $300 secured card and they charged $50 or $100 every month for gas or groceries, and then pay that down to about $10 every month, after about 3 months of doing that, you would build your score up pretty quickly. And it's very, it's quick and it's effective. We do it quite often. And really, if you were to obtain 2 cards like that, you could very quickly, within a few months, have a great score.
That's
wow.
Great.
Good. Oh, excuse me. Go ahead, Suzanne.
Is it possible for one spouse to assume the mortgage? And if so, what do they need to qualify to assume it?
So conventional loans are not assumable, and they would not be able to assume the loan. They would have to get a new refinance mortgage, which is what we would do to pay that loan off. FHA and VA loans are assumable, but they are qualifying assumables. So yes, they would still have to go through the same process of, verify. There's an assumption package that gets filled out. It's a little detailed, but they fill all this information out, and then they would supply all of the required documentation, which would be, again, if they're salaried and they have their own job, pay stubs and W-2s, if we're using support, those items as well. The key, rates are so amazing right now. There aren't too many people that want to assume a mortgage from, previous, but it happens. I mean, if the balance was really low and, everything, the stars just aligned and it made sense to do it, that might make sense in that case. But more times than not, we just would rather do a new mortgage and give them a clean start and make sure we're handling the approval process properly, because it is tricky. And so even the assumption is layered and complicated, and you're dealing with a bank and multiple, offsite people, and it can be overwhelming. That's a lot for someone, I think, going through this situation.
Michelle, when I start a divorce case, obviously the housing situation is right up there that we try to tackle first thing. And one of the things that I've suggested to clients when we're starting in the way of their homework is to call their lender to find out, is the loan assumable, number one. Number two, could one of the parties be released from it? Because from the note, the existing promissory note, because there'd been 3 or 4, maybe 5 times where lenders did do that, where there was definitely the disparity in income, and apparently they felt confident that the one party would be able to meet the obligation. So they did release the other party from that. And then the other option is to refinance. And that's when I suggest they get in touch with folks like you so that we've explored all the options. Have you heard of being able to just release someone from a note?
I mean, typically no, because there were some streamlined loans in the past. Again, FHA and VA, the note and deed of trust read at the time of closing that those are assumable loans. And of course, you do have to qualify. So in those cases where the person was released, again, I don't know the whole situation, but I'm pretty confident that at least the spouse taking over that mortgage had to qualify in terms of showing they had enough income or whatever to support the payment. And their credit was good. And again, sometimes there could be other things we don't know about, like it could be a small bank and they portfolio their loans and they have other accounts there and there's a relationship. But a typical, the average majority of mortgages out there, they're just not, they're not set up. The language in the deed of trust and note are not set up for assumable or release of a person from the note unless that other person may be qualified and there was an extenuating circumstance. And more times than not, they probably just did a modification. They probably got them approved and then just modified the note with the new loan package and then extended the remaining term of that note. So it probably was more like an assumable, like they set up a new loan and just extended the term. But again, I don't know. I mean, in general, I would say no. Most times the person would go through a refinance process.
Okay, good. Thanks for clarifying that.
Sure.
Okay, next, I wanted to circle back to the FICO score and the credit report. And again, here's where I have some confusion, and I get asked by clients what really impacts the credit score. At divorce time, it's important for us to start helping people untangle their credit cards and their auto pays and so forth. And I'm concerned that the opening and closing of accounts and the credit inquiries as a result of trying to refinance and so forth are having a negative impact. Is that the case?
Yes, and unfortunately, I think a lot of people don't realize, I've had clients in the past say, oh, great news, I paid off all my cards and I closed them all. And that's not great news because when you close that card, you lose your history. So, maybe that Chase card you've had or Wells, or I probably shouldn't say names, but whatever, different cards that maybe you've had since you were a teenager that your parents co-signed for, whatever it may be. you know, if you have 20, 30 some years on a card and you close it, the sad reality is you lose that history, and that does hurt your credit score. So what I always like to do is, you know, there's different situations, like you said, where maybe they really do need to untangle and separate. Sometimes they don't do that. You know, they're comfortable with that other person. But more times than not, what we like to do is see the credit report adjustments, you know, before making changes, and say, what do we have going on here? Okay, you have a wonderful credit score, and you guys have a bunch of joint credit and some separate credit. You have a lot of separate clean credit that, you know, I think your score would remain okay. It's okay to maybe separate those joint accounts. But, you know, you made the example, sometimes there could be a person who most of their credit is joint, and that's the majority of their credit scores because they've been together for so long. I would be really leery and reluctant to close those accounts before getting approved for a loan if they need to get a loan. So if their score is good and the credit is good and it's clean, and the only issue is that they're joint, then, and you know, this is your side and your expertise, not mine, but if something could be written up in terms of protection, like this is a card, these are the cards this person will use, and these are the cards this person will use during this process. And then after the fact, once they've gotten their mortgage, then they could separate those things. That is probably a safer way to protect the score. I know the score is not the whole goal. Sometimes the goal is to protect the person's credit because maybe the other person's utilizing credit and they're not supposed to be during this process. So, you know, I think it's case by case. And if you have a situation where there is fear that the other person might utilize credit that they're not supposed to be using and things like that, then that might be, you know, we'd have to look at that as a one-off. But in general, it's not a good idea to just go separate and close all of these accounts. It's not always the best thing to do for their score. It does hurt the score.
Okay, good to know.
Let me clarify. It doesn't hurt the score just to close a card. Like, you can close a card. That doesn't necessarily mean you're going to destroy your credit score. But in general, across the board, if you have a bunch of credit with long histories and the credit is good, you wouldn't want to go close all those accounts, is what I'm saying.
Great.
Hopefully
that brings me to another question, and we run across this fairly often, but that I call it financial infidelity. But it's where one spouse has decent credit, has worked hard to maintain the credit, and then because of the financial infidelity, or just because, the spouse's credit's ruined. So what happens then? Can they still qualify?
It's really tough. I mean, if they're joint accounts and the other person's, you know, we call it, there's a lot of reasons for poor credit or slow credit. Sometimes it's situational and sometimes it's just attitudinal, right? Like their attitude is they just don't like to pay. So if you have joint accounts with the spouse that has been doing that and has ruined your credit, there's not a whole lot you can do. Other than at that point, that would be a great time to close that card, separate your ways, and figure out who's going to pay that and how, and get it paid off, at least brought current as soon as possible, so that you can, because it's all about time seasoning in the bureau with a good history. So if you have, you know, 2 years worth of late pays on a credit card, if you can close the card to stop any future charging on it, if the card's had rough credit and a rough history, that's not necessarily a card you maybe want to preserve. I don't know. But I would, if nothing else, you know, you want to get it brought current, and then you'll need a period of time where you've paid it current. There's no magic number because it depends on how many account, and I know you guys had some questions on this, and we'll probably approach it here soon in this on this meeting. But how long have you been in the bureau? How many accounts do you have? What are your balances? What are the limits on those cards? So all of those things make up that score, right? So if all of the credit is trashed, then you really kind of just have to pause and start over and take some time to build that credit back up, meaning good payment history for a period of time. If it's a few items, then we might be able to get those brought current for a few months and be right back on track. Really just depends on how rough it is.
Gosh.
That makes sense. I know that's a little vague, but every situation's a little different.
No, I mean, that does.
Help
Yeah.
repairing that credit. How do people go about doing that, and who do they contact? Or who can help?
Well, yeah, I mean, again, it depends on how severe it is, Suzanne. We see a wide spectrum there. So if I'm looking at the credit report and I'm like, hey, we have a bunch of lates on these accounts. Let's talk about this. What happened? And sometimes, again, in like you said, financial infidelity, they might say, well, I didn't even know. Oh my gosh, I had no idea that was going on. And then
Right.
that's now we have to approach that, right? And then go through, get past that stuff, and then how do we fix it? But depending on how severe it is, Suzanne, if it's just like there's a few accounts with some late pays, then we'll coach them through it and say, here's what we need to do. Through our credit companies that we pull credit through, there are some tools called like a what if simulator, and we can go in and figure out what do we need to do. Do we need a few months seasoning on a clean credit history? Do we need to pay some things down to get the balance is much lower than the limit? Sometimes the credit history is clean, everything's just maxed. So that can hurt the score too, even though you're paying on time and there are no lates. If all of the credit is maxed, that could hurt your score. So in that case, maybe we just need to get some things paid down, wait a couple months, and then we're good to go. So every situation's a little different. And in terms of coaching, it could be fairly minor to mid-level, and that would be something we could coach them through. If it's pretty severe, like they've had a lot of lates for several years, things in charge off, things in collections, just really rough credit, then we would put them in touch with a credit repair company. I know a few that I've had great success with, and they're reputable and they do a great job. I trust them because I've sent enough clients off and had them come back with improved scores. And so if it's to that level, then I'm not a credit repair person. Obviously I do mortgages, but in doing mortgages since a long time, since the 80s, I've looked at enough credit to know typically what we need to do. And we use those what if simulator tools as well.
So you can give them an idea as far as what they need to pinpoint, and if not, where's their tipping point where they need to go contact someone that can help get them through that rough period.
For sure. Yeah, at least because I always say, a lot of times, and I know you guys probably see this, if the credit is rough, sometimes you'll have hesitation where they just don't want to call us because they're afraid and they want to fix it themselves first. And that's really not a great idea, because it's kind of like that whack-a-mole game. Like you really don't know what to fix, and you're just kind of trying to fix things on your own, and maybe you're putting too much money toward an old collection that doesn't even need to be paid, and maybe you're not addressing this item that should be paid. So it's really better to have us get involved and give you some sound advice and get clarity around it and get a plan, so you don't feel like you're on your own in the dark trying to figure out what to do. That's just never a great place to be.
You're wasting effort too, right? You can actually have a plan as far as what to do.
Time, money, and effort. Because many times the time is a big one. They spend 6 months thinking they've gotten everything where it needs to be. And then we pull the credit for the first time and we're like, yikes, this is not. And had we gotten involved sooner, we would have told you to do this and not that. So I do think time is the most important thing. Getting involved, the sooner the better, so we can come up with a great plan and get them on the road to success and to that. It's all about getting to that place where they then have that feeling of accomplishment, and they've done this on their own and they've gotten to where they need to be, and a roadmap to success is the most important thing.
So in the interest of time, I'd like to ask one more question and then we'll move on. I have often still, and I think it's probably going to continue to be a problem, student loans and divorce. Do those affect debt to income ratio? I learned something very frightening the other day on a case, that if you have outstanding student loans when you're an adult and you're of Social Security age, you can lose your Social Security because of that. And it made me wonder, what about debt to income?
Right. And so one of the problems with this is a moving target. So Fannie Mae, Freddie Mac, and FHA have changed their guidelines on this. Just as an example, in the last 7 years, probably, I don't even know how many times, I'm going to say a handful of times, So every time we think we've got it down, they change it up on us again. So right now, what we see a lot of are the following: deferred student loans, income-based repayment plan student loans, full payment student loans. So those are all different in terms of how we handle the payment. If someone has what's called an income-based repayment plan, where there's, they have $100,000 in student loans, but the income does not support that payment, they can get a very, very low reduced payment. So when you say, does it affect the debt ratio? In general, yes. I mean, we have to use something. And then it's just a matter of what are we going to use? Well, a lot of it has to do with what's set up right now. So if they're on an income-based repayment plan, we can use that payment. If they're paying a full payment, we need to use that payment. If they're in deferment and they have no payment set up at all, then unfortunately, depending on the program, we either have to use 1% of the outstanding balance. So in that $100,000 scenario, $1,000 for a payment, even if they're not making that payment, sometimes 0.5%, depending on the program. So the short answer is yes, it does affect the debt ratio. How it affects it would determine on the program and what kind of program they have set up on their student loans.
All right.
Thanks, Michelle. Thanks for all this great information. Thanks for being on with us today. Before we wrap up, I just briefly want to touch on debit and credit cards. Credit and debit cards look alike and are used in similar ways. However, there's significant differences between these financial tools. When you're spending with a credit card, you're actually borrowing money. Some people use credit cards for monthly purchases or to take advantage of points or rewards. If you do this, just make sure that you're paying it off each month so that fees aren't incurred. And watch out if you're carrying over small balances on credit cards, because over time, incurring these small balances each month, they continue to grow into a larger balance, as with it does interest charges. So essentially, you're paying interest on money that's gone, and credit card companies love this as they're raking in billions every year. Debit cards, on the other hand, make direct deductions from your checking account. If you don't have the funds to cover the deduction and don't have overdraft protection, the deduction is declined and you get charged a hefty fee. If you have overdraft protection on your account, the bank honors the deduction and you just pay interest to the bank. So keep those in mind.
Always fees. One of the most significant differences between the cards is really the liability limit for fraudulent transactions. So for instance, with a credit card, according to the Fair Credit Billing Act, you really have minimal or actually no liability for unauthorized charges. Or if you purchase something that arrived damaged or something that didn't arrive that you purchased. So you have that protection. Whereas with a debit card, your liability really depends largely on when you report the unauthorized charges to your bank. The worst case scenario is if you don't notice the fraudulent charges for more than 60 days after you receive the statement that shows that activity, you could be held responsible for paying all the charges that were incurred by the fraudster after the 60 days. And, I've learned too that even if you do report it before the 60-day period's up, you could still be responsible for a limit of up to $500. So, again, I always say, read the fine print on these things, because sometimes we just unknowingly get mixed up in high fee products, or, we end up in trouble with our bank. And I just use a rule of thumb. It makes sense to use a credit card for the large purchases or for your online purchases, and then a debit card for your everyday expenses. I mean, some people are really they really build up their travel points, their reward points with credit card use, and that's fine. Just make sure that it gets paid off so that we don't get into the debt spiral here. But well, anyway, that wraps up our segment on attaining financial independence. And again, as always, we appreciate you sharing some of your Friday afternoon with us. And tune in next time. We're going to be presenting how and when to tell the kids. And we're excited to, again, have a guest presenter, Rosalind Sadaka. She's the co-founder of the Child-Centered Divorce Network, and she's written books on the subject. So we're looking forward to that discussion. And a great big thank you to you, Michelle, of Leader One Financial, for all this valuable information. I learned a lot today and appreciate that. And you shared your Friday afternoon with us too. So thank you very much.
Oh, thanks for having me.
Oh, absolutely. And we'll be posting Michelle's contact information in the blog on our website. So feel free to contact Michelle, as she said, if you do have some questions. And again, I'd like to remind you, if you've missed any of the segments or would like to share them with a friend, they are on our YouTube channel. And finally, I see that we had some questions, and please know that we will be answering these questions in our blogs that are coming up. So again, thank you all for joining us, and stay safe and have a great weekend. Thank you. Bye-bye.
Bye.